So, welcome back. I'm not sure what video number we're on, but we are on page 10 of the notes, and we are going to start example 2. In the last video, we finished off the restricted fund method. Now we're going to look at the deferral. So, we're going to use the same basic information in the previous example. Shield will show net assets invested in capital assets as a separate component. Remember, we have a choice as not-for-profits. Okay, this is to record capital assets that weren't or that were originally expensed. So at some point they must have gotten bigger than $500,000 a year, and so they have to do this entry. Now, a capital asset donation the same manner as a contribution restricted for the purchase of capital asset. Now, as an asset is amortized, a portion of the deferred contribution is recognized as a match against this expense. So, this deferral method has no funds. Let's actually write that up at the top. It's all one big, like a general fund. Everything that's restricted has to be deferred. Everything restricted must be deferred. Okay, and in Exhibit 12.4 you can see the statement. Read through this, compare the differences between the two. Again, amount in deferred revenues, United Way grant. The deferred building campaign contributions is the restricted fund balance from the capital fund. When the money is spent, an amount will be transferred from the deferred contribution to deferred contributions related to capital assets account. So this does get a little confusing. And then eventually it's transferred to revenue. Too many words there. Once we do the example, it'll make sense. On page 11 then, you can read through this. That's part of the comparison. So here's the statement. Notice there's no columns for different funds like the other one had. Instead, it's all very straightforward. This is for amounts that are deferred until capital assets purchased. And notice it's called not fund balance, net assets. So overall, with this method, we'll have more deferred revenues accounts for restricted funds. The last method only had the United Way. This one has the United Way. But it also has others. And this is for the building. Okay, then you match revenues to expenses when they're incurred. So this is actually the opposite of the matching principle. Okay, so let's do the transactions. So we're not going to do all of the transactions because some of them are identical, except there's no funds. So we're only going to record 4 transactions that are substantially different. The other ones are similar, but there's no different funds used. The entries are done in one general fund, so you don't need fund labels. Note, fund accounting is not being used, although, like the last example, we did use the deferral method with fund accounting, for example, for the United Way in example 1. Okay, so accounts and wages payable, accrued liabilities at the beginning of the year were paid. No fund name required. So it's just debit AP 663, wages payable 70, accrued liabilities 80, and credit cash for 815. And I'm getting those numbers off page 11, just paying off those current liabilities there. So that's a nice straightforward one. Now these next ones are tricky. So during year 6, the agency announced the plan to construct a building, so everything's the same here. The estimated cost of $1,500. Government gave a grant in year 6. Remitted $450. Balance in year 7. Agency spent, so that's one thing. Agency spent $103. $91 has been paid. The rest is owed. That's the second thing. So the first one. Remember, we don't need to say any fund because there isn't one. However, it will have to be deferred because it's restricted. So we've got cash of $450. We credit deferred building contribution. And that was $600. And the rest was a grant receivable for fill in the blank of $150. So this is deferred because it's restricted. Move to deferred capital assets as purchased and record revenue. This is kind of weird. When we amortize, because remember I said we're matching revenue to expense. And when we have capital assets, what are the expenses? It's always amortization. Okay, so number 2 over here. We buy it. So we debit equipment for 103, credit cash for 91, credit accounts payable for 12. So that's the expenditure. Now we need, so I'm going to call this A. Now we need to record deferred revenue. For capital. So we're going to debit deferred building contribution for 108. So we're moving it from here and we're putting it into capital asset contribution. So it's mostly going kind of from a holding account to when it's actually purchased, it goes into capital asset contribution. That shows the money's been spent, but we don't record the revenue until we amortize it. So I'm actually going to skip down to M, and there's room on the next page because there's 2 entries here. So in year 6, amortization charges were $150, 90 was capital assets funds, 60 purchased with unrestricted funds. And as we said, it doesn't matter, the capital assets are treated the same, kind of as restricted. So on page 13, we're going to do 2 entries. One for the amortization expense, and 2, credit, I forgot to credit accumulated amortization for 150. Now, the second thing we need to do is match revenue to expense. And we're going to take it out of deferred capital asset contribution. So we're going to debit deferred capital asset contribution for 150. Now, they're able to just call it revenue, but instead they're going to match it to the amortization word. So they're going to call it amortization of deferred capital asset contributions. So that big long name is a revenue account. Now, you may be wondering, in real life, do they actually go from here to here? Sorry, here to here, and then here and not call it revenue? Sometimes not. So wherever you're working or if you're on a board, you can see what they actually do. I've seen many just go from deferred right to here and then call it revenue. Because quite honestly, especially for the medium and small not-for-profits, it makes much more sense. Okay, I think this video is going to cut me off, so I better do another one.